I often get asked the question, what is equity? What can I do with it? What does it mean? How do I create it? Equity basically, all it means is the amount of the property or the portion of the property that you own. So, if you have $1 million property, for example, and an $800,000 loan, then your equity is the $200,000 that you own. So the bank will want you to have some kind of equity in their property to allow for just in case. So say for example, the worst was to occur and you can't afford the repayments on the loan anymore, then the bank will obviously do whatever they can to try to recover those payments from you. But if they can't recover those payments, then that $200,000 in equity that you have is kind of like a surety. So what they'll do is they'll say, all right, well, you owe us 800,000. You haven't been paying the loan, so we're going to sell the property. And if they make a loss on that, if say for example they don't sell for 1 million, they sell for 900,000, then that loss is going to come out of your equity as opposed to what the bank has. So the bank will always want you to have equity in your property or equity in another property that's being provided. Just imagine it's just a way. Obviously, if the bank's going to be lending you a portion of the property, it's about you being able to put down have some skin in the game, I guess is a way of putting it. So in terms of the equity that the bank needs, ideally they would want 20% equity in the property. That means it allows if the market drops by 20% and they have to sell your property for whatever reason, then it gives them kind of I guess a bit of insurance to be able to do so. So whenever going for a loan, they'll always say, well, the maximum loan you can have is 80%. If you want more than that, you can do that. Banks can lend 90%, some banks will lend 95%. Obviously, the equity that they then have starts to shrink, and that's when the bank would say, well, we're going to charge mortgage insurance as a way of insuring that loan, because obviously they've got less equity if something was to happen. So, if it was a $1 million property with an 800,000 loan and they sell the property for 900, that's fine. They'll still recover their 800. If it's a 950 loan and they sell the property for 900, they make a loss, and that's where the insurance company steps in and covers that. Ultimately, they'll still be seeking the funds from you, even though you're paying for the insurance. So with that in mind, you using that figure again, we'll actually use the figure in this PDF. Say for example you bought a property for 500,000. So it's a $500,000 property, and then say that you had a loan of 430,000. That means you have equity of 70,000. Now that 70,000 in equity that you have, the bank's preference is that equity stays. If you want to go back to the bank and say, hey, can I borrow this extra 70? The bank would say, well, no, because we need something in this property just as a just in case. So usually they'll only lend 90, 95%. So to begin with, you might not. There's a thing called equity, which is 70,000, and then there's available equity, and that's just the amount that you can borrow over and above your current loan. So say for example you wanted to borrow 90% of 500,000. That's a 450,000 loan. Your loan's 430. That means your available equity is 20,000. So let's say after some time you end up paying your loan down by $120,000, and at the same time your property value goes up to 540,000. So it's going, all right, well initially I had 70K, but then a few years later I now have 230,000 in available equity that I can use. Sorry, not available equity. I have 230,000 in equity. And so the bank, if you wanted to borrow that equity, would say, right, well, we think the property's worth 540,000. We'd be happy to lend you 90% of that or 80% of that, depending on whether you want to pay mortgage insurance or not. Obviously, all other borrowing capacity requirements still apply. You can't just go and borrow that money willy-nilly just because you've got that equity in the property. You have to prove you can repay the loan based on the bank's assessment. So it is still something that, it's not a given just because the property's gone up in value that all of a sudden now you're going to get some funds from the sky, I suppose. You still have to borrow the money and the bank still has to be comfortable to give that to you. So the way of being able to get the equity is either you can sell the property and get that 230,000. Obviously, you'll have sale costs, maybe capital gains tax, agents fees, things like that, and then pay out the loan, and then what you have left over is the amount from equity, or by increasing the loan. So, why would you want to use equity? That could be that you either want to increase the loan to use a deposit for a holiday, or and we try to discourage using it for a holiday because that ideally should be savings that you use. But you can do that, buy a car, start a business, get furniture. There's a whole range of things, and as long as it's an acceptable amount to the bank, you can afford to pay it back. It's within those percentages that the bank is comfortable with, 80%, 90%, those sorts of things. And if the bank says yes and you can afford the loan, then they'll release those funds to you. Another reason why people do that, release equity, and this is our most common reason, is to use that equity as a deposit for an investment purchase. So in this particular case, your property after a few years is worth 540,000. The loan amount's 310,000. That means your LVR, which is the loan to value ratio, is 57%. So the equity that you have is 230,000. If you then increase the loan to 80%, in this example we're using 80%, you've increased the loan to 432,000. That's up from your balance of 310,000. So that means now you have 122,000. So your current balance of 310 minus the new balance of 432 is 122. So now with the equity leapfrog, leapfrog's one term to use it, but with the leapfrog technique, you can borrow that equity and then use that as a deposit for the purchase. So you've got a $500,000 purchase. Your loan amount of 400,000, and then you've got some costs, stamp duty, conveyancing costs, and things like that. So then your deposit is 122,000. So now you have one property with a 432K loan and another property with a $400,000 loan. Just on the by, that 122,000, it's usually done as a separate loan. So you'd go, okay, well I've got a $310,000 loan. Plus now I've got this separate $122,000 loan, and that 122 is specifically for whatever you're using it for. So if you're buying an investment, then it's for investment purposes. If you're using it for a home, it's for home purposes. So that's in a nutshell how equity works. And generally speaking, a lot of people would build up equity in their home just naturally by property prices, property values going up. And it does create a lot of opportunities, which is great. But you do need a balance of not just the equity available, but also your ability to repay that.